Hey everybody, this is Alex Merced from alexmerced.com and learneconomicsnow.com. The reason being is that this is going to be a more economics focused video about bonds and interest rates because I get a lot of questions. Actually, my video on introduction to the bond market is one of my most popular videos on YouTube. So I figured I'd create a new video explaining the bond market and interest rates, mainly focusing on interest rates because interest rates are, the way I like to think about it is I like to think of it like it's the cost to rent the money. So think about like going back to Blockbuster back in the day and renting a movie. Okay, the movie is what you borrowed. Kind of like, let's say, $1,000 that you borrowed, also known as your principal. So the Blockbuster movie is your principal. But in order to borrow it for the 5 days that you borrowed that Blockbuster movie, you had to pay a rental fee. We'll say $5. Same thing for the $1,000 you're going to borrow from a bank or from whoever. But that extra money is called interest. Okay, so think of it as the cost to rent money. Okay, so I got to pay back, and like renting anything, you got to give back what you borrowed. So in this case, $1,000. Like I have to give back the Blockbuster movie. That's my principal. That's not an expense. That's just me giving back what I borrowed. But there is an expense in the fee I had to pay for the time that I rented it. In this case, the interest. Now, an important thing to understand is sort of where do interest rates come from. Bottom line is interest rates are a price, a market price like anything else. So the rate that you have to borrow is going to be dependent on supply and demand factors. Now on the demand side, it's just going to come down to the fact whether people want to spend. Okay, if you're looking at, in Austrian economics, they'll refer to this as something called time preference. So the more I kind of want to spend money now, the higher my time preference. So if I really, really want to go buy a t-shirt right now, you're going to have to pay me more to convince me to not buy the t-shirt and lend you my money. So the more society in aggregate kind of really wants to spend the money, the more you're going to have to pay them to borrow that money, because you're basically have to pay them enough to put off gratification, to put off buying that t-shirt, a burger, something else. Vice versa, if society as a whole is not in a rush to spend money, so they're like, okay, I don't really plan on spending this anytime soon. So if you'd like to borrow that money in the meantime, go for it. That would mean I have a low time preference. Okay, and that's just the way it is. But that's only the demand side of what sets interest rates. There's also the supply side of interest rates, which comes from the amount of money out there that's lendable. That depends on whether people are saving money. But the amount that people, so basically somebody out there has to be like, I'm not spending my money now. So they're going to save it, which is actually them acting on a low time preference. They're not rushing to spend their money. So by acting on their low time preference and saving money, what's going to happen is that there's going to be a huge supply of loanable funds. So then lenders out there who have a lot of loanable money, they're not going to be, whenever supply and demand, whenever there's a huge supply of something, it's going to be cheaper. So the supply being huge, to lower the cost of interest to borrow that money. Okay, so bottom line, supply and demand. Although you can manipulate those factors, okay, and this is where a lot of central banks and monetary policy plays a role. Okay, so the Federal Reserve tries to manipulate time preference. Now, if you're looking at this from a Keynesian framework, the term they would probably use is something called the propensity to consume, the willingness to consume. Similar idea, except you're taking out the time element from it. Okay, so Austrians take a look at, not that you don't want to consume, is you may not want to consume now. While Keynesians are like, oh, you don't want to consume now, that's a problem. Okay, so terminology matters. So while they're talking about the same concept in these two economic frameworks, when you're using time preference, you're not saying that people don't want to consume, you're just implying that there's a difference in where they want to allocate it over time. Well, when you just say propensity to consume, you're just talking about whether people have an urge to consume in the moment. And that leads to sort of a difference in the way you think about economic problems and their nature. But bottom line is the Federal Reserve and other central banks can manipulate this by just increasing and decreasing the supply of loanable funds. So people will say that the Federal Reserve prints money. don't technically print money. They don't actually print pieces of paper and just throw them out of a helicopter. As fun as that is to joke about, and central bankers themselves have joked about it. What they really do is that the way central banks work is that they control the amount of money out there. Essentially, they can actually spend money that doesn't exist yet. And it's just an accounting entry, especially nowadays when a lot of our financial system is digital. Okay, so in that case, I don't necessarily have to spend physical paper money. It can just be a record that this money was spent. So the Federal Reserve will go buy things with money that just didn't exist before. It'll just sit there and say, and that's when they say they're expanding their balance sheet. Because what the Federal Reserve is doing is that they're going to go to banks and buy U.S. government debt off them. The reasoning being is that out of all different debt instruments, U.S. debt has the most stable value. So that way, if you need to sell it later, you can sell it for the same price you paid for it. So you can basically swap a dollar in, dollar out. But basically, the Federal Reserve or any central bank will, well, let's say the Federal Reserve will buy U.S. dollar denominated debt, specifically U.S. government debt from the banks. And the banks now have more money. Now, the Federal Reserve, what money are they using? Money that didn't exist before. So then what happens? The Federal Reserve has more assets in total, so its balance sheet has gotten bigger. Okay, when later on, if it wants to take money out of the economy, so basically by buying these bonds or this debt from the banks, banks have more money which they can lend out, and again, supply of money, the more you're going to be willing to lend it at a cheaper rate, so you'll lower interest rates. But if they want to raise interest rates or stop them from falling and tighten, they'll just do the opposite. All those bonds and debt that they bought off the banks, they just sell it back. But when they sell it back, it's not like that. It's not like they keep that money in existence. The money just stops existing. So now they have less assets. So that's what they mean when they say they shrink their balance sheet. Just so you understand the terminology, when you hear people on TV talk about how the Fed is increasing its balance sheet and decreasing its balance sheet. Okay, cool. So that's how you can have manipulation of interest rates. But the thing is that this increase in the supply of loanable funds, this decrease in the supply of loanable funds, isn't because of individual behavior, isn't because people are saving more because they don't necessarily want to spend. It isn't because they're saving less because they want to spend. Okay, so in that case, the interest rate is no longer a reflection of individual preferences. And the reason why that's important is because interest rates can help determine which types of investments make sense. So longer term investments, like let's say building an addition to your restaurant, building out a factory, these are investments that won't pay for themselves for many, many, many years. So when you have generally higher interest rates, it doesn't make sense to borrow the money to do these investments, because when you take a look at what your return you're going to get versus the monthly payment on the loan, it won't make sense. So as interest rates go down, it makes more and more sense to take on these kind of investments. Okay, doesn't mean you won't invest the money. It just means these specific types of investments which are riskier. The reason they're riskier is because you're borrowing money for a long period of time, and generally building that factory, one, doesn't happen overnight. So it may take 1 or 2 years to build the factory, and then another few years for it to pay for itself. So if that factory doesn't generate stuff that people are buying for this long a period of time, it's going to turn out that was a bad idea in the first place. So you're taking a fairly large bet, okay? But it makes more sense when interest rates are lower, because again, the cost of the financing, the amount of financial risk you are personally taking is less, okay? Which makes sense if rates are naturally low, because that means people are setting aside resources for a period of time, so those resources are available. Because again, even though someone just saves $1 and you're thinking it's just $1, those dollars are a claim on actual resources that are out there. Okay, to take a step back for a moment, imagine if I collected bananas. Okay, so we subtract money out of it. My savings would be the bananas I set aside to trade with someone later, because maybe there's nothing I can find that I want to trade my bananas for. So I save some bananas for tomorrow, and then I'll trade with people tomorrow. That's savings. I'm setting aside actual resources. The only difference is that now we trade goods and services through money. So when you save money, you're actually saving a claim on stuff that actually exists. So when you create new money, You're creating new claims on stuff that exists, but you're not increasing the amount of stuff that exists. That's kind of why you end up having inflation in the long run, because there's only so much stuff. Cool. Okay. Now, moving on. So the Federal Reserve lowers interest rates. People take on more. And again, it's not that they wouldn't have invested otherwise. They just would have invested in shorter term, less risky investments, because this interest rate signal would have signaled them in a different direction. And what are like shorter term investments? That's more like making more of things that are quickly to make. So providing more of the existing goods and services that already exist. Okay, you're not necessarily doing research and development, bringing new things to market. You're just sort of making a quick buck. It's less risk, less reward, but you need to make that money faster to keep up with the interest that you're spending when you're talking about higher interest rates. So again, it's just different types of investments. So with higher rates, I'm going to stick to safer investments. While with lower rates, I might be willing to take a little bit more risk. And there's other reasons for that as well, but that's the basic idea, okay? But again, what's happening is that I'm taking on these riskier or safer investments based on the interest rate and what the interest rate signals to me. And if the signal is not tied to actual individual preferences and what people are actually doing, are they setting aside those resources or not setting aside those resources, what can happen is that we end up making the wrong calculation in the way we invest compared to the actual resources that are out there. Okay, so, but you don't notice that because these are long-term investments. So you don't notice it for many years. That economic activity, that moving of money looks like a big boom, aka a bubble for a period of time. So it all feels really good. Okay, because the idea is that when an economy grows, it can keep growing long as those circular flows of money, now I'm getting into sort of more Keynesian terminology, if those circular flows of money are sustainable, meaning they're built on economic relationships that are not going to just disappear. Okay, so basically, imagine those initial long-term investments causes a creation of movement of cash that creates other economic activity to begin, that creates another layer of economic activity. But if this bottom piece falls apart because it was just that money was put to the wrong place, then everything on top of it collapses as well. So the key thing is that you want people to not just invest for the sake of investment in riskier projects, because more risk, more reward, or just to spend money. Because again, everything that's going to build on top of that is going to be based on whether that initial investment made sense. Now again, even with proper natural market interest rates, people will make bad investments that don't pan out. But if you distort market signals, you make it easier to make the wrong choice. And you make it where more people will make the wrong choice versus the right choice. So think of like the economy as a portfolio of investments. The only difference, instead of having one portfolio manager making a bunch of investments, every entrepreneur, every charity, everything is a bet. If market signals are good, then more of those people are going to make more accurate bets, which means more of those bets will pan out. Not all of them. People always make mistakes, and that contributes to the learning process. But you still want more bets to win than lose. When that happens, the economy grows. Now, if market signals are distorted, what's going to happen is that more of those bets, some of them will win still. Okay, there's people who still succeed despite bizarre market signals. But what's going to happen is that more of those bets are going to lose than win, and the economy's going to start shrinking. Okay, because the idea is when a bet wins, you have more than you started out with. And if you have more base, same thing like a portfolio. If more of your stocks win than lose, your portfolio grows. If more of your stocks lose than win, your portfolio shrinks. It's the exact same idea. Okay, the only difference is that instead of a centralized portfolio manager, you have a decentralized portfolio selection of individual entrepreneurs and other enterprises. Okay, so that goes a little bit more to interest rates, market signals, the economy as a whole. So in that case, and again, that's going to influence how people borrow money and the debt markets. So this is why the debt markets are so important, because this is how it's going to, a lot of things are financed through debt. Now, while some businesses are financed through debt, some are financed through stock, but governments solely finance through debt. So those interest rates movements also have an effect on how governments make decisions and allow governments to maybe overspend in times that they shouldn't. especially leading into a boom, or during the boom leading into a bust, and maybe I wouldn't say a government will ever underspend, but basically the government is just going to be as confused by these market signals as any other actor in the economy. So, and be influenced by these market signals. Okay, so that's sort of the more how the economy coordinates and whether it coordinates well. But from an investment standpoint, you have two types of investors. You have investors who don't want risk, who are going to try to always seek less risky assets, so things like government debt, and then you have investors who are willing to take risks to get the return that they desire. Now, if you understand that there's those two kinds of investors, you can kind of predict where that capital is going to go. So, just as a quick example to make a point, after 2008, when the economy collapsed, interest rates started going down. Okay, which means the amount of money you as an investor could make was going down in the U.S. economy. Now, investors who were just already risk-averse investors, who were just scared already, just rushed to U.S. government debt. So they ran to the risk-free asset, U.S. government rates. And again, what happens when everyone buys the same thing, the price of it goes up. And when the price of something goes up, especially when it's a debt instrument, interest rates go down. Think about it this way. If I were to sell you a burger, okay, and you were to eat that burger, you get a return, right? You enjoyed that burger. So let's pretend you enjoyed that burger 8%. If I were to double the price of the burger, are you going to enjoy it as much? No, your return, your benefit, your enjoyment of it's going to go down. Vice versa, if I cut the price in half, it's going to go up. So what happens is when everyone rushes to buy government debt and pushes up the price of U.S. government debt, the return on government debt goes down. Interest rates go down. Cool. And then what happens is that riskier assets, since all the safe investors are leaving the riskier assets, their prices are going down, their returns go up. So then what happens, all these other investors who are looking for a return, who can no longer get a decent return in safe assets because their rates have gone down, they're going to go rush to those risky assets. Okay? And since the Federal Reserve was pushing interest rates as a whole here in the US down, they went to like emerging markets, other places where they could get higher rates. So, and this is sort of, if you're someone who works in the financial industry, you have to kind of imagine all these different types of investors and their different behaviors responding to these market signals. Now, if you're an economist trying to think about, theoretically, what's the best way to make the economy work for the most people possible, then you really care about market signals and whether those market signals are allowing people to make the right choices with actual resources. We touched upon a lot of topics in these last 15 minutes. My name is Alex Merced from alexmerced.com and learneconomicsnow.com. I also do a podcast called Economics Why Not, which you can subscribe to on iTunes, Stitcher, and Google Play. If you enjoyed this video, please share and tell others about the video. And also, just check out everything else I do over there at alexmerced.com. Thank you very much.